All right, welcome to Benny and the Squirrel. This is our 51st episode. We got my buddy Larry McDonald. It's actually kind of fun. My very first podcast on my old podcast, I had these two guys on as guests, and now we're all back together, boys.
The band is back.
Yeah, Larry's joining us from New York. Larry's the founder of the Bear Traps Report, and the Squirrel's joining us at 4 a.m. from Hong Kong. So we have another one of those podcasts where we got a lot of time zones involved. Welcome, Larry, to Benny and the Squirrel.
Guys, thank you for having me, and it's an honor to be on with you two because I think you talk macro better than anybody on the public broadcasting. I can tell you that much.
Well, you probably get more out of us than the money, honey.
Yeah, but I tell you, 1 million copies sold of A Colossal Failure of Common Sense, as well as When Markets Speak. So I'm really proud. We just crossed 1 million books sold, and I tell, as a former Lehman trader, Squirrel, I tell my wife once a month, if we sell 1 million books, we'll break even on our Lehman stock.
Well, you did it. You did it.
Congratulations.
You overcame Dick Fold, basically.
You are known on this show as the bookseller. You know that.
Well, he sold 2 million books. He's got to be the bookseller.
I'm just disappointed you haven't got them laid out behind you, but you've got a posh dinner setting instead.
Yeah.
All right, let's get it going. Larry, I'm on your chat. I'm one of your clients. And one of the things I think you do well is, you talk to a lot of smart guys and you got your nose to the ground. You're a good tape reader. Like, we're at an all-time high. We hit an all-time high today, but, you're noticing some divergence, as we will. Let's start it off on what you're thinking high level, and then we'll kind of go detail.
Well, the biggest one this week is Home Depot and the suppliers. So it's not just Home Depot. We went through, there's a new Bloomberg function, which is quite brilliant. And so you pull up the Home Depot equity, and with this command, you can get all of their suppliers. And my jaw dropped. You were talking about 30 suppliers in Home Depot that are off the last 30 days, 10, 20, 30, 40%. The Whirlpools of the world. Whirlpool CDS is now blowing out. So you get a big credit problem there. And not much equity. In other words, 2 billion of equity and maybe 7 billion of debt. And a lot of near-term debt maturities. So we're seeing some real credit weakness in companies that have exposure to the consumer and to oil risk to the consumer.
That's the supply chain function, SUPLC for any of you, or SPLC for any of you guys.
SPLC's been around for years, hasn't it?
No, they updated. So I'm looking at it now. It used to
it.
just be like a flow chart. Now they're showing you the performance and the percentage of their revenue. It's actually, they did a good job. I'm looking at it right now. It is nice.
Finally, Mike Bloomberg's got some competition snapping at his heels.
Right, exactly.
So we can get into that a little bit, but let's go to that.
So let me ask you guys. I want to ask Rupert a question because what I track are narratives, and so I think if you do enough ideas dinners, we're at the Harvard Club tonight with some of the best chief investment officer level dinner. Yep. And then we talk to people like Rupert, people like you, Ben, and we really crowdsource the information in the chat. So this whole SLR thing, we started to hear about Besant's bag of tricks over a year ago. But Rupert, what I've been hearing the last week from some of the best macro minds in our Bloomberg chat is that the rate of change of, say, JP Morgan's reserves at the Fed are down like 200 billion in a relatively short period of time. And it's basically, all that means for people listening to us right now is you're going from reserves at the Fed into treasuries. And I think they're as nervous as a whore in church because the UK bond yields are breaking out. I'm talking about treasury. The French bond yields, global yields are breaking out. So what they're doing is they're kind of forcing the banks to own about a trillion more of treasuries. At the same time, they're supposed to do what we call quantitative tightening or reducing the balance sheet according to Warsh. But the bottom line is the bottom line, it's like stealth QE. It's percent and Warsh working together. That's why the silver bid is like, if you look at the positioning on silver, like the rate of change of incoming flows and the positioning itself is really turning into bullish. So I think it's because of this stealth QE that it's got hard assets moving a lot. Look at copper today. What do you think, Rupert?
I listen. The silver move. We should probably set to one side. I think there's separate things going on there. I mean, there's clearly China treading on the bid again, rather than a sort of general global shift towards, because it didn't move alongside gold or platinum. It was very, very, very idiosyncratic to the white metal, right?
Okay.
But I think this stealth QE game is something that people have been used to for quite some time, right? And it's been, Janet Yellen made it famous, and Scott Bessent's putting a cherry on it,
right,
and having criticized it so vocally from afar. But this administration needs asset markets to be buoyant, right? That's the whole MO for this administration. So it doesn't surprise me hugely that they're goosing the liquidity.
Yeah, and so, basically, let's get into kind of what we're talking about here. Larry is talking about. Well, actually, let's start with this, Larry. You were just on Fox News, and I texted you, and you were talking about the semis, which, by the way, I got hit on trying to fade in April. I know you're kind of on my boat here. I mean, is this the narrowest leadership we've seen in like 25 years? I mean, you guys have both been in the game longer than me. What do you think?
it's so pathetic. It's just it gets more narrow by the day. And if you look at the semis, when you're this high above the 200-day moving average, you're like 64% above the 200-day for an index of 30, 40 stocks. It's extremely, extremely unusual. And it's much higher. Like the previous record was like, I think, in the high 40s. And so you're just at a very dangerous spot. You got a lot of momentum players chasing, right? And momentum, it works until it doesn't work. And then, but I tell you, the most sexy thing about the short for the semis is in the last 10 days, we've had a couple of real big candle reversals, and up today, but big, huge candle reversals where money's actually coming out of semis and back into software. So that spread between semis and software, which is like almost a category 5, what I call hurricane capitulation in the software versus semis. In the Bloomberg chat and at the dinners, I'm starting to see the best and brightest tech investors that we've known for a long time, really good semi investors. They're selling semis or shorting semis and going long software.
What kind of software? What kind of software, Larry? Because I think that
right.
That I'm sure I'm still short. Have been short plenty of software names,
right.
And I think that there are parts of the universe like security and anywhere where you've got a sort of either a data lake moat or a regulation moat, but the rest of them, I don't feel good about their long-term future.
I completely agree. No, this is be more like a counter trend trade, especially when the first half of the year, a lot of times, the problem is we're a little bit a ways away. But what I've noticed the last couple of years is when you get that first half of the year, so July 1st, you're going to have a big kind of rebalancing. The same thing on the quarter end or the month end, right? So that's what I look for. I look for the quarter ends or the month ends for that kind of rebalancing. But you're right, Rupert. It's you got to be very careful when you're picking these because some moats are 5 to 8 years of defense, and some moats could be a year and a half, no moat at all.
No, it is extraordinary, and the pace at which the whole sector has been reassessed is something I don't think I've seen. I've never seen a market change its perception on an entire sector so rapidly in my career. I mean, it's just like, oh my God, it's a dodo.
And
right?
the one thing I would say, guys, is that the second, third, fourth order effects from inflation, we saw PPI today. When it comes to supply chains, like we had Grant Wilson, the CEO of Taiwan, on one of our meetings, and he made the point that the critical minerals, the chemicals, a lot of very important ingredients that are in the semiconductor construction process are at high risk here, because we've closed the straits for 72 days, right? And so the probability that we already have a hiccup on the bottleneck for the semiconductors in terms of construction of data centers. It's just a complete mess. If you talk to anybody on the ground, whatever the street's saying on terms of construction of data centers, it's literally 20-30% too high relative to the reality of energy and relative to the reality of building out and getting the materials there. But then there's the global supply chain of the critical minerals, the chemicals, all the things that go into semiconductor. So the probability that we have like a real hiccup in this space is I think extremely high the next 3 months, and it has a lot to do with the straits being closed.
So I'm go on, Ben.
No, I just think look, Bloomberg now has an index that you can see the price of compute, and it kind of skipped up. But as you guys know, I'm involved with the AI company called Second Brain, and I've gotten a lot of learning in the last 6 months, and we are now extrapolating the most inefficient we'll ever run on any of this stuff. Okay, that is where I think the big disconnect is that the way that these things, and I don't want to get this into an AI conversation too deep, but basically we're going to get more efficient. Yeah. And we're extrapolating token demand at a linear to exponential rate. And then all these shit businesses, because as Larry Rupert will tell you, he's refinanced these DRAM companies a few times in his day.
Hynix was my nightmare in 2000, 2001. I mean, it was, I actually got to write that up, I think, at some stage. It's a story that needs to be told. It really does. Too many people,
especially right now.
Yeah. Well, I mean, to be fair, I'm cheering on the semis bulls this week, because I put on, we were talking about it on Sunday night. I put on a calendar calendar strangle on Monday. So I'm long topside June calls on SMH just to fund my puts for September.
Okay.
Try to build up the piggy bank for the put. But I mean, I guess what I'm going to say is that I think that the smartest engineers in the world are all working on this memory problem. I think there's an architectural problem, and I think the average guy in the street, there's some guys who know, but there seems to me a large gap between understanding what's actually going on the front line and what the market is doing. And I think in a world of 55% passive options, trend following, there's just not that many thinking participants. And as Larry and I both can tell you, fading a mega move is not that fun. So there's just the arbitragers with thinking participants are just a minority. And so you just get these moves, whether it was silver, Q4 until January, or it's this now, or Palantir in 2025, or, we can keep going with this list. This is kind of how the market works now,
Yep. There's a lot of call buyers.
Let's keep going. One more thing on breadth and then we'll move on. Larry, you had this. Today we had 1 out of 3 stocks down, or only 1 out of 3 stocks were up, and we hit an all-time high. We had 9% of the index hit a 52-week low. Those are both near the records, all-time records. And then, Larry, your chart here shows you there's some deterioration within the broad composite of NASDAQ. I mean, do you think that this is the kind of thing that is gonna come up on people? We talk about beneath the surface, or what's your thinking on this?
Well, when you see this with high yield underperforming as well, right? So triple C's, I mean, we'll get into that.
We have that as well, right here.
Yeah, triple C's are not like triple C's are the best indicator of economic risk because it's the junk of the junk. And so
That's how I titled it.
it's the real. And so if the triple C's are not making new tights with the equity market making new highs, and then you add that into breadth, it just tells you that there's a lot of companies that are worried about the consumer or the impact of high. Like there's a good chance we could have like 8% inflation again because of the second, third, fourth order effects of the strait being closed for this long. Everyone's looking over that and saying, okay, if Trump does a deal, to me, it's all muscle memory. It's like everyone lived through 2025, where on April 10th, whatever it was, Trump reduced the tariffs one morning and the market went crazy. And a lot of people missed that trade. And so it's recency bias, and everyone's looking over the inflation risk because they think, okay, Trump's just going to do a deal. Magically, we're going to have 5 factions in Iran get along. But the bottom line is he's not negotiating a real estate transaction in Manhattan. It's not the art of the deal. He does have those 5 factions, and 2 or 3 of them don't agree with any deal that he's going to do. And that's why we're going to have ripping, roaring inflation in the third quarter of this year.
Would rate cuts fix it, Larry? I'm sorry, would rate hikes fix it?
Oh, sorry. No, that's the thing. Yeah, well, yeah, you're into the same.
Because I'm genuinely concerned about the power that the central banks have to stem this kind of inflation.
Right. I don't think rate hikes would do much of anything at this point because it's all.
I'm drifting into that camp that says that you up the rate on the T-bills for the boomers, and actually inflation carries on charging.
But they actually don't have to hike, Rupert, because if they just threatened aggressively to hike, the market that would really take some steam out of asset prices.
Bond market's already saying that. I mean, it's no fun being a sofa bull right now, isn't it, Ben?
Right. So what have we gone from 3 cuts to maybe half a hike priced in, something like that?
Yeah, yes. No, I mean, about a half a hike. We have it. Let's see. I think it's right here. Basically, we're getting to the point where, it's best to look through the 2-year. But I think it's a half a cut. And this is the first time in 2.5 years that we've had the Fed funds rate be eclipsed by the 2-year, which I tend to think of the 2-year should be the actual Fed committee. We don't need these politicians in there doing this. The 2-year does a good job. You know what I mean?
You're not alone. It would save a lot of money on economists, wouldn't it?
We put a lot of PhDs out of jobs. But yeah, I mean, as both of you guys know, I've been a rates bull, and I have gotten hit pretty good on the SOFRs this year. But I don't have the slide with me, but I think we have to remember what happened in 2008. In 2008, we had a commodity boom. We had 5% CPI in the summer of 2008. We went from Bear Stearns evaporating in March of 2008 to, we're going to price hikes in, and everything was fine. And then it quickly was demand destruction. So, the DS9 euro dollars went from 97.15 down to 95.75, and then back to 99 by the end of the year. So that's still kind of my analog. But running from the spring, call it March, to the pain point where oil keeps being a real pain in everyone's ass is not fun, especially if you're running trading leveraged positions, which when you trade stars are. But let's go back for a second, because you mentioned it about Walmart and the inflation. But you sent this chart to the Bloomberg chat, and we had our little AI engine soup it up a little bit, but we got no wage growth on a real basis for people. So all this inflation in butter prices and copper and oil and et cetera, is eating into people's purchasing power on a real basis, right? So is that why, you know, we had Cuppy on the show and he's like, I don't want any exposure to the middle of the curve or anything that's related to GDP. And we're kind of seeing that, right, Larry?
Right. In other words, that's part of that whole Home Depot, the supplier risk, this whole same thing with high yield. If people have less purchasing power, look at the restaurants, look at McDonald's or Darden. It's just amazing. And then look at the outperformance in this chart of, say, Walmart, which is your real potentially defensive play versus say, a Home Depot, which is real consumer discretion, right? Because if you're building a home or you're putting on an addition. So you think about Walmart versus Home Depot, this spread, it tells you exactly what you're saying, Ben. It tells you that the market's pricing in some type of big hit to the consumer and people are moving toward defensive recession-proof stocks right here in that chart.
Yeah, and I think that goes
what does Walmart trade on right now? What kind of P does Walmart trade?
Oh, it's insane. It's probably
part
40.
of it. You got to back out some of the assets they have, the minority positions. That is one reason why it looks extra high. Like they have that Instacart in India in there, and they have a couple things. So it looks.
I don't care. I think the idea. I really don't give a shit. The idea that there is safety in.
I completely agree.
Walmart and Costco's. Yeah.
Total bullshit.
You're running into a burning building as far as I'm concerned. Now, I'm not saying they're not great businesses, but if we get a sort of train wreck of a market, there's not going to be a stock in the index that's trading at sort of a squillion times sales, right?
Yeah.
Everything gets derated.
Did you just combine squirrel and a large number? Is that what you did right there?
That's a new thing. It's a squillion. It's a squillion. It is TM'd right now.
All right. Let's talk about this also, because we're talking about the cash flow side, and I think a lot of analysts, especially equity analysts, like to talk about the cash flow side. One of the things, Larry, that Rupert and I did is we wrote a report about SpaceX, and we just saw, I'll bring this up, we saw a headline yesterday that Anthropic and OpenAI and maybe SpaceX are going to rug pull some of these secondary sales. And in some of the off markets, you've seen them get hit. So our question is like, who's going to buy the paper? And, you are the guy who loves to talk about the S&P inclusion, right? Well, now they're going to, Rupert wrote a letter to the NASDAQ and wrote a letter to the S&P. Like, what's your thoughts on them trying to change the rules in order to accommodate this deluge of paper that's coming to the market?
It's the scam of the century. It's a bunch of private, VC guys wanting to cash out and dump their shares onto passive investors, American 401ks. If you think of the S&P and the NASDAQ, you're over 50% technology, and now we're going to take $4 trillion of equities. Maybe it's about 300 billion of equity, but the company valuations are around 4 trillion for those three IPOs.
I got it laid out on the slide there.
Yeah, SpaceX, Anthropic, and OpenAI. So yeah, it's one of these things where the pitchforks and the protests and this is going to really help the socialists when this blows up, because capitalism should not work this way. We have to out this garbage while we can. There's an evil point to passive. I talk about this in our book, How to Listen When Markets Speak. We call it the dark side of passive investing. There's a point where, you think about it, there should be an illegal point of passive. And all that means is if you get active managers here that are, say, 45% of asset management, and passive, and all that means is indexes like the S&P and the NASDAQ. If passive goes to 60, 62%, that's really evil. It becomes more and more gameable. That's where you get the whole inclusion scam. And now you're waiving the rules. Jack Bogle and the way the S&P worked, Rupert, for all those years and through the 70s and the 80s, they wanted a 1-year period where there was a review process, checks and balances. And now, because some guys want to cash out and dump their shares on indexes that have to buy, not to mention the index trackers. There's like hundreds of these tracking funds. Don't you think, isn't it just like a big...
Oh, you mean the closet benchmarkers?
Right, because they have to...
I crunched the numbers on all of this for our SpaceX report. And the funny thing, Larry, is even though, as horrendous as it seems, even though they're going to co-opt all of the active, the real passive money plus the closet benchmarkers, I think they're still left short on the SpaceX IPO. I don't think they still need to find real demand from people with a brain to the tune of $30 to $40 billion, and everyone that wanted the rocket ship company has had an opportunity to buy it at much lower prices, through 14 rounds,
right,
plus secondaries over the last decade. And you really think, I really struggle to understand that there's enough of a bid around the hedge fund community to sort of bridge that gap to the passive dump, right? Because Vanguard's not putting an order into the ECM book at Goldman and Morgan Stanley, right? There will be some timing mismatch which needs to be bridged by the hedge funds.
Right?
I
see what you mean. Yeah, so for the IPO moment.
The trouble with those arbitrage trades is that everyone thinks they're going to be the guy that sells the stock first to Vanguard. Guess what? It doesn't really work like that. And there's going to be a sort of you Spider-Man moment. That's my forecast, at least. But I agree with you in terms of this gaming. I really do. I mean, and the other thing I think that we should probably look to is buybacks, right? Now, we've been talking a bit about the diversion of free cash flow from buybacks to AI data center CapEx. But, it's only, we were all in short trousers, but stock buybacks were illegal 30 years ago, right? If you want to give some money back to your shareholders, you gave them a special dividend or up to your regular dividend. And there's so much nonsense being played with buyback with buyback flows, largely to recycle stock-based compensation and all of that. I just think that we're heading towards a moment where all of this stuff is a no mass moment.
Ben, doesn't it remind, if you're listening to Rupert, doesn't it remind you of say 1987 in the sense that there's a lot of quantitative games going on. Back then we had that portfolio construction and insurance. And then, so it's a lot of that. There's a rates issue globally, right? And there's a valuation problem. And we're coming into the summer and we have these IPOs that, they're going to come, and the first IPO is probably going to kill the next two. And because that, like Rupert says, you've got so much buying that's needed for the first one. And it just smells like we really could have a messy September, October here, like we're talking like an 87 type situation.
Yeah, but Jensen went to Beijing, so it's all good.
Yeah, so just one thing I want to show you guys this. We've talked, Larry, you've talked about this. You wrote about it in your book. We're seeing the commodity inflation. Squirrel's been on that trade. We had the hot PPI this morning and CPI yesterday. But this chart on the left, this is, you can't see it as well because I squeezed it. That's the CPI component for software. We haven't seen a rise in CPI for software, since I've been in the game. And actually, I'm sure if it goes back far enough, since you guys have been in the game.
How do they calculate that?
We can go into CPI methodology on a different show. We don't.
No, but
But that's index. So I, again, as both of these guys know, have been the bond bull. I will have to say, it feels more and more stagflationary as you look around. We're going to need to see, I guess when I think about it, it's like the government deficit. Larry, you remember we were talking into Trump, how I was telling you, okay, this should be deficit reducing, tariffs. Well, the tariffs thing's kind of gotten pushed aside, the Supreme Court and all that. And we're up to, I think, 1.9 or almost $2 trillion plus the CapEx bonanza. It's hard to see, we're all talking about the consumer's weak, right? Commercial real estate prices are clearing. The residential housing markets, so there is asset deflation, but it's just maybe this is just overwhelming it, right?
I have to say, Ben, I was looking at my sofa line yesterday, and I was going, "Do you think our partnership would survive me bailing out of the Z7s?"
Of course.
But I'm getting. No, I'm joking. Of course I am. But I'm getting close to the Tal moment on that position.
No, I mean, without question. Like, and I'm being more, hey, look, the Strader Hormuz thing changed the dynamics, right?
Yeah.
Like, I think that you before had the CapEx and the deficit, and that was why we just weren't going down as I thought. And maybe some of us are still stuck on when capitalism actually worked in the pre-GFC model, right? We've lived in this fiscal dominance model that got accelerated by COVID. But I don't know, Larry, what do you think? You're our guest. What do you give us some thoughts?
Well, I think it's three things though. It's the CapEx, and so just look at say Caterpillar. The highest percentage above the 250 week of all time. So it's up like 166% above the 250 week moving average. The previous record was 103. And so it's the CapEx, the 2 trillion of CapEx. It's the fiscal, like you said, the 1.9 trillion, and then it's the straight being closed for 72 days. If you add those three things up, this is real. This is what I mean by 87. Like the probability that we have crazy spike in inflation. And remember, if you take the CPI from yesterday and you just do the 3-month average and you extrapolate that out, you're getting up near 6-7% just by taking the last 3 months and pushing it forward and annualizing it. And it's hard to believe that with a straight close for 72 days, the second, third, fourth order effects of not just helium and not just fertilizer, but look at trucking right now. Trucking costs are the highest. They're breaking out. Everything in trucking has to be transported. Every good has to be transported. So if trucking pricing is breaking out, which it is today, then that's massive inflation. So the probability that we have like some runaway scare on inflation, which Ben, I think you're going to be right on your cuts because that's going to, if it's really fast, right, it's going to create a heart attack,
exactly,
and economic shock, and then the economy is going to slow down so fast that bonds are actually going to rally.
And look, again, we talk about ergodicity, like in markets, it's about sequencing. So many guys were taught an inundated efficient market hypothesis and think about markets without sequencing in time that your P&L can't handle it. Can your investors handle you taking massive drawdowns, but you're going to be right? You know what I mean? Like, optimizing for being right, which is probably my biggest mistake in my career, and optimizing for P&L are two different things. And, when you think about liability structure as probably the most important thing in money management or banking or whatever, finance in general, you got to think about it. And I think Larry, I remember Larry and I talked around Christmas of 24, and he was all nervous that he wrote this book and he wasn't sure if it was going to come through. You're looking pretty good now, buddy.
It was really tough because when we wrote the book, they made us, we had a fiction ending to the book. We sold over 300,000 copies now, but the original version was a fiction ending, and they made us come up with this portfolio for the next decade, and it included uranium, gold, silver, copper, and I'll never forget. They told us to do this, Rupert. We were under direct orders, and then when we sent the manuscript back, one of the editors said, "Hey guys, are you sure you want a chapter on uranium and nuclear power and gold and silver?" like they were trying to talk me out of it because I was too invested in hard assets.
That's a good sign, though. I mean, I remember. To be fair, Larry got me long Freeport McMoran in March of 2020, around $6-7, and I'll love him ever since because that was a good stock.
We didn't know each other. We didn't know each other then, but I was with you in there.
Yeah, I mean, look, that was a real time to buy commodities. Was March of 2020 and all of 2020, honestly, but really March, April, you had a generational time to buy it. We've had, because, we've had to start and stop with it. But like, you look back at the 70s, you had to start and stop, right? We had the commodity run in 20 to 22. Then we kind of like went off for a little while. And now we're clearly back because almost everything's at new highs or close to new highs. But, Larry, you put this chart out. This is kind of a well-run chart. The U.S., the long end is clearly broken trend, right? And this is just like a symptomatic reality of fiscal dominance is kind of the simplest way to think about it, right? I mean, the population's getting older. The labor force is not growing faster. I mean, what else can be going on here?
Yeah, it's everyone. This is what's driving money into hard assets. So think of like the psychology of the bond investor. So duration. So think of like all the people that own UK 30-year bonds and all the people that own French long-term bonds.
The 61s.
The 61s. And like everyone's losing money. And so if that's okay if it's like 1 year, but once you go into the third year of that, it changes human behavior and it forces people out of duration and into hard assets. So Rupert, I hear this stat all the time. Let's vet this thing out. So from 1968 to 1981, we had a multipolar world, global conflicts, higher inflation. And by the end of it, about 3.5% to almost 4% of household wealth was in materials, as in gold and silver, copper. And right now we're still, in terms of household wealth, we're still down at 1.5%, right? So it's easy to say that the commodities are up a lot, but think of like all that household wealth that's in bonds, that's in what I call financial assets, are just paper certificates. But you know what I mean? So that's a bond.
Well, look at India this week, right? Modi goes, it's your national service to stop buying gold. What do you think the knee-jerk reaction to that is? It's. I mean, listen. I mean, what you say in terms of share of household savings is so true. It's just like the energy share of the S&P 500, right? It just is the wrong number, right? We've spent a lot of this call talking about the 40% tech weighting, but the 3% energy weighting doesn't make any sense, right?
Right. And the NASDAQ 100, here's another stat. Like everyone, you see all these idiotic charts on Twitter that show the NASDAQ today versus the rally. It's like they show the rally from 1999 or 1998 to 2000, and they put.
Well, they're going for that double top analog, right? Well,
they kind of like. The point is that we're nowhere near the rally of.
I know that annoying chart.
But then when you look at the wealth, if there's 37 trillion in the NASDAQ 100, and that was, do you know that was just 12 trillion at the end of 21? So for the end of 21 into the first quarter of 22, we had 12 trillion in the NASDAQ 100. Now it's 37 trillion. And so if you think of like in terms of all the wealth and all of that, we're so much crazier today than we were in 1999, 2000. If you just look at the 37 trillion in the NASDAQ 100, right?
Yeah, I mean, the wealth effect was relatively inconsequential back then.
Yeah,
right?
Because households didn't have that much wealth in the stock market the way they do today. Because passive investing wasn't even around, right?
Well, and that's kind of, if you think about the 1987 thing, you guys know I like to think about fragilities and hidden fragilities. Like the U.S. economy is levered to the S&P unlike it's ever been, or maybe like you got to go back to the 20s or something like that. But like we're at a point now where the legislation of the PPA putting all these people in the passive, taking the S&P to whatever 7,500 today, and I guess that would be a question. I talk to a lot of people, rich people, not rich people. There's an anxiety out there. Like it doesn't seem like everybody's happy. Like I see a lot of people stressed, and but do you guys remember like in 99, 2000, it felt like it was ubiquitous. Everyone was making money and everyone was optimistic. This feels a little different, doesn't it?
Yeah, it does. I remember being so bought into it, and really believing in owning those, the global crossings, and it's like it was the biggest rug pull in the history of markets, global crossing, and
So
Cisco systems.
I took Asia Global Crossing public. It was about
Oh, God.
it was about the last deal to get out.
Well, we can all sit here and say, "Oh, U.S. rates," but Larry, you talked about this a little bit recently. Our Rupert's home country of the UK, those boys are having a little bit of a bond problem over there, and Europe as well. So the U.S. is still relatively the cleanest dirty shirt, basically.
Right, but the higher yields globally, they tend to drag the U.S. up because there's just the yield, almost the UK 30 years almost 75 basis points, almost a 1%, the 3/4 of 1% higher yield than the US. So it tends to drag up US yields, and I think that's what's happening on the long end.
I think that's right. I think that's right. I mean, the relative size of these bond markets relative to treasuries is, I think that's I mean, ultimately there is a signal function between the two. I don't think I don't think that yields can move in opposite directions at the sovereign, the G7 sovereign level. I think they have to move in lockstep. And so it's a bit of a nightmare scenario where everyone's hostage to the worst performer, right?
Yeah, and the election in the UK, Starmer. The thing with Starmer, it's outrageous because over the last 30, 40 years, if you had an election that was this one-sided, Starmer would have had just a classy move and would have resigned, and you would have called elections. But he's really holding in there.
Do you know what? It's local elections in the UK, and this is a subject I do know about.
Yeah.
They are always a classic process. It's always the fringe nutters that outperform in local elections. Now, I'm not disputing the fact that Starmer is legitimately unpopular, but this is everyone just angry with life right now.
Yeah.
Nigel effing Farage is not the great messiah. Let's be very clear.
No, it's just a protest vote.
The populists do not have solutions, right? Let's be very, very clear on that. But I do think, I do think that Starmer has completely squandered his majority. To a certain extent, when you get a majority that large in a general election, actually all you do is create an opposition within your own party, right? Because there is no incentive. You can't give out enough government jobs, etc., because you've got too many in your parliamentary party. But he's not being a good leader. But my concern is the alternatives don't look great either.
Right, but you could have, because of the crazy uncertainty and kind of like you said, the protest vote and all of that, and then the ability to finance the budget, you could have like a real breakout in yields.
The irony is that the political problem that they've created for themselves has largely been because they have been way too scared of the bond market. Right now, I'm not talking about going into battle with the bond market, particularly as the UK is a massive external borrower. But the fact of the matter is that there has been so much timidity around plans for growth, around what they do on the fiscal side generally, that actually they've kind of overcompensated for the trust moment back in 22. They're so scared that they've got paralysis, and that's led to massive voter anger.
I see. Okay, so you're not in the camp of like it's more of like the Liz Truss moment in fourth quarter of 22. Kind of put it, really froze things.
So Rachel Reeves. Now I don't really rate her. I don't rate her as a chancellor. But the point is, she's so traumatized by what happened to Truss and Kwarteng back in 22 that she's not doing anything about it.
Right.
Well, she's timid to make bold moves. right? And, you know, ultimately, when you look at the way in which the world is changing right now, bold moves around sovereign resilience, defense, education, you know, healthcare reform, that stuff needs to be fixed right now, right?
Yeah.
Anyway, here endeth the lesson. You brought up, Benny.
Yeah, it's a mess. Let's talk about something fun that we can all shit on. Bag holders and private credit. How about that?
Oh yeah, bring it on.
Yeah, Larry's in New York, about to have a fun dinner. You know, Larry, what do we think about private credit right
I mean,
now?
this is such a joke. I mean, you create these wacky new rating agencies out of one living room in Westchester that rated, you know, literally hundreds and hundreds, if not 1,000+ securities or more. And the insurance companies have been really just table max, getting longer and longer and longer private credit. And then you have this $2 trillion that's CapEx that's coming after software credit. So it's actually creating more credit risk because it's wiping out software companies. It's creating more default risk inside of private credit because a lot of the loan market is software. So you have all this CapEx, which is creating more credit risk in the private credit area. The insurance companies are long all this stuff because the software companies were considered like the most guaranteed cash flow generator in the world the last 10 years. Yeah, so yeah, I think the biggest bag holder, I'm seeing a lot of clients that I respect, short the MetLifes of the world. And then you have the rate risk from commercial real estate that still hasn't gone away.
Yeah. So do you think it's systemic, Barrett?
Here, huh?
Do you think it's systemic, right? Yeah, there's going to create some lumps and bumps in the life sector. You know, there are going to be some endowments and some pension funds that get it between the legs. But does it morph into something bigger for the market?
It's not. Right? It's not systemic. No, it's just not. It's not big enough relative to subprime and every single home in America. But the one thing that would be systemic is where you have a real inflation shock that causes the bond market to really buckle because of, higher rates. Like we just can't, like the US, if the US 10-year is 5%, the market will crash because there's just too much, and then the bonds will rally because the market will crash. There's just too much debt that's underwater relative to interest rates. And so if there's some inflation shock that that would be pretty systemic, I think.
Yeah, one of the things I have a chart on Bloomberg I created is the Dallas Fed gives out, forget about the non-marketable, right, that sits in the Social Security and all that. It's not even actually Treasury debt. It's like Treasury-like. But like using the marketable par and then comparing it to the market value, which the Dallas Fed has a time series on, we're at like a $1.8 trillion gap in mark to market, right? Like that over that, we go back to that 10-year period of the really nice bond bull of the rates just going down. The market value was exceeding the par value the whole time. So bonds were just the place to be, right? Because you have the negative correlation, the positive carry, and the capital appreciation just working for you. And now you have the correlations flipped and you have a gap. And so these banks or whoever's sitting on them, I know they're replacing them because 22 is now 4 years in the mirror. So we don't have the same level of fragility because, it replaces, but it's still a big ass gap, and in that there is a point where it's going to hit. And I think I'm with you, Larry, that a 5% level is the level for the 10-year that will be the line in the sand. And, maybe that's what has, and, we talk about this getting to the other side. Maybe it will have to be the bond vigilantes or whatever that take us, and because there's no fiscal discipline anywhere, and the bond markets are starting to assert themselves, not via selling, but just kind of no bid, right? I mean, because we don't see any like massive gap downs. It's just every day, 2 bips, 4 bips.
And you think about all the wealth, right? So the 37 trillion in the NASDAQ 100, the trillions of dollars that are in equities, right? So when Lehman went down, we lost about $7 trillion in the stock market, but we made back 4 trillion on bonds. And that's because of that yeah, I mean, it's interest rates, bond prices down. In other words, bonds typically did the opposite of stocks. So if stocks were falling, bonds were rising. And and so to keep it simple, whenever we've had since 22, whenever we've had like a hit to the market, whether it be the 22 bonds and stocks sold off together. And then in 2025, in that first quarter, bonds and stocks also sold off together. So for the first time in a long time, we're not seeing that offset, and that's another thing that can get into this. It's not systemic, but just like it was. Imagine if when Lehman went down, equities lost 7 trillion, but you made back 4 trillion in bonds. That was a really nice buffer that I'm not sure if it's there anymore.
No. I mean, listen, there will be some kind of reaction function, but it's only the agile and the leverage that's going to get any kind of buffer, performance bump out of that.
Yeah, I mean, the U.S. equity market cap is 80 trillion, 75 trillion, something like that now, and non-financial credit is 80 trillion. So you're talking about 50-50 debt, debt to equity ratio, whereas back then it was much more levered, right? And that's not even including the massive amount of off-balance sheet swaps, the Eurodollar funding, funding mechanism was much. So it is a different market in that sense. And the shadow guys that we were just talking about, the PC guys, which, clearly are not having a good time. They still have a better liability structure. When you were at Lehman, Larry, there was a reason you guys were doing that
borrowing
crazy
overnight from Tokyo
because you needed to get the funding to keep it together, right? Like
living in the repo market.
Living in the overnight market. I mean, with hindsight, it looks just wildly crazy, right? But every single investment bank was levered that way. I mean, Citi.
But that's how, Rupert, you just nailed it. That's how delusional the market can get, and people condition themselves in finance that was okay. And that is absolute insanity. Now you look back and it's revisionist, but like it's just like it's amazing that the Dick Folds of the world thought that they could do that forever.
So let's talk about something positive, because I think we've been a fairly cynical board here.
Hey, we have the author of the bear trap.
Larry, you've been talking about China, and I've been hearing some of my brokers starting to pitch some Chinese upside. And you put this chart out. What are you guys thinking? We're liking China here.
Well, we did a trade alert on the KWeb and the FXI 3 or 4 weeks ago on the buy side. China, the KWeb equities 3, 4, 5 weeks ago were really oversold relative to NASDAQ. And then they weren't pricing in any love from this Xi-Trump deal. So I think the move up now in China technology and Chinese equities is, the dollar weakening again, the potential deal with China and the uncertainty of that kind of being in the rear view mirror. And so, so it's a good place to be. And I think it's definitely more of a trade than a great long-term investment because of all the, long-term structural China problems. But yeah, I think it's been a good trade. I think it's going to continue to be a good trade.
And listen, it's been a great trade for 2 years, Larry. I think ultimately,
right.
Chinese equities have blown the lights out over the last 2 years. At Tencent and Alibaba reported last night. I mean, I'm in Hong Kong. Yeah, I mean, a little bit disappointing. And actually, the Baidu Alibaba, the BAT complex has really sucked wind since Q4 last year, relative to something closer to I actually totally reconstructed my China book in the last couple of weeks, put a piece out the other day. I think equities are now being pitched by the party as a legitimate savings vehicle for the population.
Right, and it's just like the United States. Real estate
and
blew up, and now they're trying to push people back to equities, right?
well, they want people in equities, right?
Yeah.
And you've got to put under anything other than they don't want crazy degeneracy in the equity market. But if you're positioned in low beta, high dividend yield, that kind of China equity, which is not the K-Web, it's much more the sort of the Chinese constituents of the DVYE, which is the iShares high emerging market high dividend ETF. I think that's where you can be in for a 5-year, 10-year position rather than a K-Web trade.
Rupert, let me ask you guys a question, especially Ben, because of your AI. So there's a number of guys in our chat. So we do the dinners like tonight, and we do the chat. And when I hear like 3 smart technology people say the same thing. So in China, we obviously have the DeepSeek moment, right? Which was a threat to Mag 7, and then we had a little bit of a drawdown, and then it kind of went away for several reasons, right, which we can talk about. Now this Kimi platform where they're taking Claude code, is what I'm hearing. They're running it through Kimi. They're ripping off Claude. They're throwing code into open source, and that's like throwing it into a piranha tank, right? So if you take valuable code if you pirate code and then you put it in this Kimi and then you get it into open source, and aren't they just ripping off all the US CapEx? And all of a sudden, China AI, if it's marginally competitive, doesn't that like re-rate our entire artificial intelligence valuations?
You may talk about AI. You may talk about AI, Ben. Go.
Yeah. Rupert always tries to keep me at bay. Rupert and I were talking about this last night. We're kind of working on a piece, and one of the pieces of it is if I'm Xi Jinping or I'm advising Xi Jinping, well, look, you have a commodity bent, Larry. Well, we've seen China dump steel for how long, right? We've seen still dumping solar. So why wouldn't they dump open source cheap AI? Because if the U.S., as we talked about, is so levered to the S&P, and the S&P is now, we're talking about the breadth, is so levered to the AI trade, well, dumping cheap AI, which is subsidized by the state, seems like a good destabilizing strategy to me.
It sounds like Pearl Harbor to me. Yeah.
Like a better Pearl Harbor. Like people aren't dying, they're just like seeing their.
But that could be one nasty weapon, man. Because you could vaporize hundreds of trillions of dollars of U.S. wealth in a very short order.
Yeah, and again, if you think about the idea that the S&P is 55% passive, well, that means that most of those people have no idea what they own, and then you have the quant guys who are just kind of chasing performance. And you have the mutual fund managers and hedge fund managers who, go and placate to the market because it's too painful to underperform. So they're owning more than they probably are comfortable owning. There is a fragility that's set up. And that seems like, from a statecraft standpoint, what you're saying is right. And I use Kimi a lot, actually. I use DeepSeek. I use Quen, which is Alibaba's. Like, these models are cheaper. And they're, look, they're running at negative margins or like roughly negative margins. So the money has to come from somewhere, right? Because it is transferring power in so someone's paying for it. But
what's so funny? One of the popular narratives here in Asia is that, Alibaba and Tencent are underperforming because they suck in AI, right? And the reality is they're just focused on using AI to, drive their other businesses more efficiently. They're not viewing it as a product to sell. It's a tool to make their other businesses and products more powerful. And I think that narrative is going to reverse quite quickly.
Well, guys, our guests are starting to arrive. I'm kind of
Wave
up
them
against the
in.
clock.
All right. Well, let's just finish it with this. Larry, are you kind of still in line with this? Is like kind of where you're thinking? This is, you talked about your imaginary end of the book positioning. Is this kind of roughly in line? We're talking bullish China, still bullish commodities, kind of negative on consumer, negative on the index.
Yeah, like industrials, materials, and energy. They topped out in 1980-81 at 49% of the S&P 500 composition. 49%. In recent years, we got down to 12%. Maybe even 11 for those three: industrials, materials, and energy. Our thesis is, and people say bear traps and all that stuff, and I think it's funny, but we've been balls long: copper, platinum, palladium. I mean, just like what we did was like incredibly. I'm really proud of the whole team, and there's no I in team. I give my team credit. Yeah, but we're like massively long everything else tech besides tech, and oh, by the way. Look at today, Rio Tinto destroying NVIDIA, BHP Billiton destroying the NASDAQ. And we're talking like up 40, 50%. Yeah, so this is, and these companies are still just a fraction of the S&P 500 composition. So yeah, they can go a long way from here.
There's money to be made out there. I agree. Larry, thank you so much.
Thank you, guys.
You're better. Please come again soon.
Okay, and great job. 51 episodes.
Yeah,
that's awesome. I mean, that is really awesome. I mean, that takes a lot of discipline.
We appreciate guys like you coming on and talking. Larry, just let everyone know where they can find you. You have different tiers of your service, so it's not just for institutional guys.
Yeah, the read-only product is the Gold, the Pro, but they can find us on Twitter at ConvertBond. It's info@thebeartrapsreport.com. In the 2 books, over 1 million copies sold, How to Listen to Markets Speak, and A Colossal Failure of Common Sense. Go out and pick one up today.
Love having the bookseller on. Larry, thank you so much.
Always selling his books.
Thank you, guys.
Be on for me. Have fun at the dinner. Have a little FOMO while I'm not there. Thanks for coming on, buddy.
Okay, guys. Bye,
Thanks,
Rupert.
Larry.
Bye, Ben.
Bye.